right. Welcome everybody to the China-Africa Research Initiatives Conference on the Political Economy of Chinese Finance in the Americas. The session today is one of the keynote addresses for the conference. It's a great pleasure to introduce our main keynote speaker, which is Stephen Kaplan. Stephen is an associate professor of political science at George Washington University. And he'll be talking about his new book, Globalizing Patient Capital, the Political Economy of Chinese Finance in the Americas. I've been an admirer of Stephen's work for a long time. I've been following it. He was studying Chinese exchange rate policy before it was cool, way ahead of everyone else, including myself on that. And he's also an expert on Latin American political economy and has done lots of important work in this area, including his book, Globalization and Austerity Politics in Latin America, published by Cambridge Press in 2013, which is also the publisher of this book. I'd like to just welcome Stephen to SAIS and look forward to hearing his presentation on his brand new book coming out soon. Look at it at your favorite online book retailer. So Stephen, welcome.
Thank you very much for the wonderful introduction, David. It's a pleasure to be here at SAIS today. Thank you very much to Deborah Brautigam as well for having me here. I'm excited to present my work to everybody. So bear with me one moment as I share my screen and bring up my presentation. Excellent. So basically today, as David highlighted, I'm going to be presenting my book project to you called Globalizing Patient Capital, the Political Economy of Chinese Finance in the Americas. So we can start the book's puzzle by looking at the following graph, right? This shows cross-border claims by nationality in US dollar billions, effectively looking at who are the largest creditors, bank creditors globally. And you could see, right, where traditionally it's Germany, United States, United Kingdom, Japan as well would be up there. You could see China prior to the global financial crisis and was doing cross-border lending, but much more kind of on the level of other rising powers such as Brazil, right? Then you see sort of since the global financial crisis, China really taking the opportunity as a lot of Western capital began to sort of move out of countries, come back home during the crisis. China saw this as an opportunity in regions like Latin America to expand their financial presence. So we see, right, China now is among the top 5 global bank creditors internationally, raising the question, right, to what extent does China behave like other creditors historically, such as the United States or United Kingdom? To what extent, right, is China doing something differently? Are they behaving differently? And if so, what are the implications for national economic policymaking? So I, of course, believe that China is distinct, right, from other type of lenders internationally. Hence, I've dubbed the term patient capital, which was initially affiliated, right, with sort of the East Asian development literature back in the 1980s, but more of a domestic focus, right? Looking at the extent to which bank creditors domestically were willing to sort of have a longer time horizon and oftentimes cross holdings, right, across different sectors in the private sector in order to marshal resources and drive development over the long run. So essentially, when I see China, sort of their approach internationally, is very much emblematic of that sort of East Asian patient capital approach that we saw initially as part of the East Asian development model in the 1980s. And effectively, what I see China doing today is globalizing that model. And also, it's a bit unique, even compared to those domestic examples, because in the international realm, of course, some of what China's doing is distinct, or at least distinct in terms of now having a rising power a developing country that's now sort of a main global creditor, right? Essentially, how does that change the approach to credit and finance, right? And that in itself, we see China embodying principles that are important principles historically dating back to the Verdun Conference, in the 1950s, such as non-intervention, right? So I'm going to make the claim that indeed China's approach to international capital is unique. And here are the following reasons, right? One, you do have that long maturity structure, so it's similar to other bilateral lenders in that way, but right, unique in terms of the scale, right? China's really marshaling tremendous amount of resources compared to other bilateral lenders. Also, compared to the private sector, the maturity on the loans tends to be quite long, right? Average maturity anywhere from 17 to 20 years. And of course, it has an infrastructure-oriented nature to it as well. Also, really importantly, and this ties in with my point earlier about the global financial crisis and China sort of taking the opportunity to emerge as a global creditor during that time, is that it has a high risk tolerance, right? Typically, when we think of different, Western approaches to capital, even among institutions like the World Bank that may have a longer term horizon, oftentimes there's a notion of, well, it still has to be a bankable project, right? It has to have that individual profitability. In my book, right, I make the argument that China often is trying to maximize markets rather than individual profitability of any one firm. So as a result, they have a higher risk tolerance, and they're using their policy banks historically in a way that's oriented towards building a market presence, right? Not necessarily just building a portfolio of bankable projects. So China has this high risk tolerance historically, right? Looking for cheap assets, market share, even improving key logistical skills such as marketing, distribution, and local engineering capabilities, all in order to promote and internationalize China's firms. So essentially, right, China's operating in kind of these strategic credit spaces in order to kind of spur economic activity and commercial opportunities for China. Of course, as we've seen around the globe, right, yes, there's risk tolerance. It's not limitless, right? In an age of COVID and even before COVID, we do see sort of China entering defensive lending at times, right? In countries such from Venezuela to Pakistan, where yes, they've been patient, but patient has its limits to some extent too. And so then they have entered in the last few years sort of a restructuring phase with many countries, including within Latin America, from Venezuela to Ecuador. Finally, another key element, right? Well, first, before we look at the last key element of China's patient capital, you can see here, just as an example, if we look at China's FDI into Brazil, right? Typically, what's happened with Western capital when there's a shock, right? Typically, there's sudden stops, right? Where even if capital's been coming into a country during an economic downturn, there tends to be capital flight, but there's a lot of kind of short-term capital that tends to move out of the country. So we see here, for example, during the 2008 global financial crisis, China's different. Also during the commodity downturn in Brazil, China was different. Also looking at Brazil's impeachment and car wash scandal, right? In 2015, China was different. China came in buying cheap assets, right? Looking at downturns economically as opportunities to buy for the long term. What explains this in part too is that compared to Western capital, right, where there's a fair amount of Western capital that's oriented towards bond and equity markets and short term in nature, a lot of what's moving out internationally from China has a much longer term focus, right? And so it has that ability to also be risk tolerant, right, and buy during these dips over time. So one other key feature then of China's lending is sort of, right, a lack of policy conditionality, right? Typically, we know that with Western financing, there's often a focus on policy conditionality, right, or ties to policy conditionality, meaning, right, if you accept Western financing, oftentimes there's sort of a set of policy conditions that comes with it. ranging from having to balance your budgets to perhaps, other remedies, ranging from privatization to liberalization, right? Comparatively, China's approach, right, is embedded in non-intervention in domestic affairs and the 5 principles of peaceful coexistence, right? So comparatively, rather than having these kind of policy conditions, China tries to avoid, right? They might have consultations. The CDB may say, hey, we think it's good, Venezuela, if you sort of try to balance your budget, et cetera. They may say these things, but it's not linked to the funding, right? It's not linked to policy conditions. And as mentioned, right, oftentimes it has more of a commercial orientation in order to promote Chinese market maximization internationally. So what we instead see, right, just because there's not policy conditionality, it doesn't mean that there's not conditionality, right? So what we get instead is what I deem in the book commercial conditionality, right? So the financing is secured through loans that are collateralized in a variety of different ways, right? It can be through future deliveries of commodities, right? Where effectively there are 2 different contracts, right? One contract would have a state-owned company, such as an energy company, selling, right, exports abroad to a Chinese company of oil, right? Then they would net proceeds from those sales that they would put in an account, right? A special account. And that account would be used to repay the debt. So future commodity deliveries is one way of hedging this financial risk. The other ways, right, of hedging financial risk that we'll talk about later are kind of state guarantees, land guarantees, resource guarantees. But also, right, there's kind of a tied aid commercial component to this as well, where there's guaranteed contracts often or purchases of Chinese firms, guaranteed contracts with suppliers, or even commitments to buy Chinese machinery, right? So effectively, where traditionally Western, right, financing is tied to macro conditions, we see often with China that their financing is tied much more to the micro, right? Microeconomic conditions, market maximization. So let's actually look, this graph here shows the percentage of GDP of various different kinds of financing that governments have, right, within the Americas. And you could see historically the amount of Chinese policy bank loans prior to the global financial crisis was very low. But then we see as a share of GDP, this growing over time compared to other kinds of financing sources from governments, ranging from bonds to multilateral loans. So in effect, right, we, by kind of 2010s, we start seeing Chinese policy bank loans accounting for a similar share of GDP as other multilateral loans to Latin America. So then the question becomes, what are the implications of this, right, for national economies? Does it change, right, the conditions under which governments are borrowing and hence their economic policy making behavior? Well, part of the argument that I'm going to lay out here is going to reflect the investment channel. So you could see here within Latin America, with Chinese policy bank loans, oftentimes they're state-to-state loans, meaning, right, the loans go directly from Chinese policy banks to governments like Venezuela or Ecuador. Comparatively, however, sometimes those loans end up being more market-oriented, right? Meaning, instead of going directly, right, to other governments, those loans instead oftentimes are directed towards corporate entities, right? So for example, if a government is having an auction of sort of an infrastructure project, various corporate enterprises may be bidding on that, right, project. And effectively, the financing goes directly to those enterprises to make that bid more effective, to make it more competitive. Ultimately, right, there's also flows from China that would go directly towards foreign direct investment as well, right? But in terms of the loans themselves, generally, right, they're either going to the state or to more market-oriented destinations, particularly directly towards Chinese corporate enterprises. Why does this matter, right? So effectively, it matters for the following reasons, right? If we think of two different investment projects in a place like Argentina, the conditions, the terms, the level of indebtedness, all this may vary greatly depending upon whether it's state to state or instead flowing is just highlighted through a private procurement channel, right? Towards sort of infrastructure bidding more broadly among many sort of corporate enterprises. So the state to state channel, one key difference is in the project's terms. So in a place like Argentina, direct contracting is allowed, where the government can directly contract with Chinese banks, that's the Argentine government, if the lending is concessional, right? If it's more competitive than the market, according to Argentine law. So that's one key difference, right? Another key difference is with state indebtedness, right? Generally, when you have these state-to-state loans, China doesn't have policy conditionality. They can't hedge risk with policy conditions the way the World Bank does or IMF does. So they have to hedge that risk in other ways. So effectively, it's very important for China that Argentina provides a state guarantee of that loan. Meaning if the loan is not repaid, Argentina, right, will repay that loan with resources, right, or land or other things within Argentina to make sure that it makes good on its commitments. Also, what's really key here is then the nature of the flow, the investment flow as well, where yes, you have sort of a Chinese commercial content with these state-to-state loans. For example, if we look at these hydropower stations in Santa Cruz, Argentina, about a quarter of those loans go to Chinese machinery and equipment. However, about 3/4 of those loans are paid directly towards the Argentine government in fungible civil works projects, giving them some spending discretion, right? Another key element here is transparency, right? There was a lot of concerns about what was in these contracts. These contracts weren't terribly transparent in order to build these hydroelectric plants in Argentina. And in fact, because of these concerns, when the Macri administration came in to govern in 2015, these hydroelectric plants were actually suspended under the Supreme Court legal ruling because of these environmental concerns. Eventually, after the project was stalled for a while, the project went on, but then eventually there was a lower number of turbines and generating capacity in order to be more environmentally friendly. But you can see the trade-off with this project, right? You get more discretion in terms of the loans, having them be state to state, but there's also then a lack of transparency, right? There's not always, so the details aren't always clear to the public. And with these particular projects, there was a lot of concern about environmental sustainability, right? The quality of the drinking water, the national landmark, Perito Moreno Glacier in Argentina, and the effect that this hydroelectric plant would have on it, right? And it was unclear because the fine print of the deal wasn't clear. Comparatively, we can look at the private procurement channel. Here we have in CARI Solar Park, a privately managed auction system rather than a state-to-state loan through Renovar. And we see the Shanghai Electric Power Construction won the bid for $390 million. But sort of then let's look at comparatively what's happening with this loan, right? As mentioned, it flows directly to corporate enterprises that won the bid rather than the Argentine government. So there's no room for this extra spending discretion. But you still have this Chinese content element, right? So China's Exim Bank has preferential export buyer's credit to purchase things like Chinese machinery and equipment. Now, comparatively, given sort of the privately managed auction system, also came with a fair amount of transparency compared to the government loans. So local communities had to be consented. They received training to work in the plant's construction and operations, and even participated in the profits according to sort of the terms of that privately managed auction system. So comparatively, when it flows directly towards corporate enterprises, you're not getting that extra government spending, that discretion, but you are comparatively getting more transparency. So let's look at some of these trade-offs now in a bit more detail, right? So first, we're just going to present some stylized facts here that show sort of as China's bilateral credit as a share of a government's overall external financing, as that grows, what we also see in this graph here is that sort of primary budget balances, right? Deficits, right, becomes negative. Deficits grow more and more over time. So as China's bilateral credit is responsible for a larger share of total public external financing, right, budget deficits also tend to be associated with that as well, right? So that's kind of a first look at, okay, to what extent with China's policy bank lending to national governments, do we get more discretion? Do we get more spending? Let's look at this in a couple more ways now. Here's the regression analysis as well. And you could see that there does seem to be a difference with Chinese lending relative to other types of creditors, right? Here you see Chinese lending, when normalized by external debt or GDP, it has a negative relationship with fiscal deficits. Essentially, as China's state-to-state lending grows, fiscal deficits tend to grow as well. Comparatively, however, if you look at other kinds of instruments, we don't see that same pattern. If you look at the bond markets as a share of GDP, we see instead a positive and statistically significant relationship with budget balances, right? Effectively, budget balances tend to tighten and narrow, right? The more bond financing you have. With multilateral loans, not surprisingly, that have policy conditionality, such as budget discipline, right? Budgetary targets, fiscal targets, we see as multilateral loans are normalized by debt or GDP, also a positive association, right? That they tend to be associated with smaller deficits, narrowing deficits. It's the exact opposite of Chinese capital, right? So the statistics support this notion that Chinese capital can expand policy discretion in the fiscal space. We see this across a range of different models, right? Statistically significant negative coefficients here. You can also see it if we look more broadly at sort of a few key government borrowers in Latin America over time. Here we have Argentina, Costa Rica, Ecuador, and Venezuela. And interestingly, right, many of these governments as well tend to have leftist partisans during the period of this graph. And what you could see is that even with left partisans, in the 2000s, we have budgetary surpluses on average in these countries. Then you could see as Chinese financing emerges, right? Those are the blue lines there, right? And as they grow, as they get lower, right? As Chinese financing grows over time, we see budget deficits start to expand over time as well. Now, not surprisingly, 2008 was a crisis year. Not surprising to see counter-cyclical Keynesian policies in response to that crisis. We'd expect to see the fiscal deficit widening to some extent. However, it never comes back. Without the scrutiny of Western finance, we see in these countries that fiscal deficits continue to expand over time. And that's sort of the key insight here. Comparatively, if we look at other countries, right, Brazil receives lots of Chinese policy bank financing as well historically. However, it hasn't been through the state-to-state channel. Brazilian law requires that everything must flow through private procurement, right, through sort of a natural bidding process, a competitive bidding process. And so remember, the argument there is when it goes through that channel directly towards corporate enterprises, rather than government intermediaries, you're not going to get that same fiscal discretion. And in fact, what we see in Brazil, right, even though in 2014, right, as we know, during that election year, there was a wider fiscal deficit than normal, right, under the Rousseff government, as it tried to gain policy space going into the election year, which eventually became very controversial because there was a question of, sort of the way this fiscal space was engineered and the extent to which there was sort of balance sheet engineering in order to do it. But that being said, what we see in the wake of that is in Brazil, there's actually, even by 2016, a constitutional spending cap put in place, notwithstanding a recession, right? So there's Chinese policy bank financing coming into the country. It's going into, right, the corporate sector, corporate enterprises, rather than flowing through a government intermediary. We see Brazil reliant mainly on private financing, market financing, and as a result, it continues to target budget discipline, notwithstanding being one of the largest borrowers of Chinese financing. So the next thing I want to do, we have about 15 minutes remaining or so, is now dig into, right, this term I highlighted before called commercial conditionality, right? I kind of highlighted two things that China does differently. Is one, it's trying to maximize markets internationally, right? Use these policy banks and sort of the implicit subsidies that these policy banks operate with in order to expand commercial opportunities internationally. As they do this, instead of having policy conditionality, China has commercial conditionality, right? And it comes in two forms, right? One form is oriented towards promoting Chinese commerce. The other form is oriented towards managing sovereign risk. So in terms of promoting Chinese commerce, we see bilateral sort of flows are very similar to bilateral tied aid, right? Where effectively, if you're going to use Chinese financing, no different than other countries, okay, you also then have to contract, right, with Chinese firms, buy Chinese machinery, essentially expand China's foreign content. We oftentimes, right, with these kind of loans too, see commercial interest rates. They generally, oftentimes, they may not be concessional. They may be more competitive to markets, or they may be less competitive markets. We see in places like Latin America, great variation, right? We see Ecuador for a fair amount of time paying very high commercial interest rates. Comparatively, Venezuela was paying lower commercial interest rates. And to some extent, that reflected sort of maybe China's desire to have a presence historically in Venezuela, right? It was really important early on, before Venezuela's crisis, from a commercial standpoint, in order to expand China's energy footprint. And so to that extent, right, Venezuela got some better terms from a commercial interest rate standpoint. Also currency promotion, right? Renminbi promotion are also a key part of this as well. Now, comparatively, there's also commercial conditionality, right? Where if China doesn't use policy conditionality, we can raise the question, how do they hedge their risk? What do they do, right? Policy conditionality is designed in order for governments, right, when they're borrowing from an entity, right, when they're borrowing from a Western lender, in order to kind of have budget discipline. If they have budget discipline, if they manage their fiscal, right, accounts well, then they'll be able to have the resources to repay their loans, right? That's part of the idea. The other part of the idea is kind of, economic as well, in the sense that if, economic as well, in the sense that if China, or if sort of we see that, flows are kind of, coming in to, some of that too is kind of economic, right? That if a country is able to have austerity, have policy conditionality, then the hope is the extent to which they're shrinking the state and expanding the market presence, that will encourage FDI to come in and stimulate economic activity, right? But comparatively, if China says, okay, we're not going to use policy conditionality, they have to hedge this risk somehow. So how do they do it? One, they put a lot of emphasis on administrative channels, right? And if there's a conflict, they'll reach out to the government, right, and have a state-to-state negotiation about that conflict. When the Macri administration came in 2015 in Argentina and said, okay, we don't know about these in the environmental sustainability of these deals in Santa Cruz that China is financing. And as a result, we're going to have a stay, right, through the Supreme Court on the project, and we're going to stall it. China then writes letters, right, directly to the Argentine authorities saying, hey, look at the contract. We have a default clause in that contract, right? Cross default clause. If you do not continue this project, right, in southern Argentina, these hydroelectric plants, we'll pull the financing from another key development project in the north in terms of the Belgrano Railway, right? So you have these administrative channels that China could work through using things like cross default clauses from the contract, right, in order to make sure they're maximizing Chinese interests locally within the deal, right? You also have things like commodity guarantees, commodity-backed loans, as we mentioned before, right? Essentially securitizing the loans either through future deliveries, right? And the proceeds of those future deliveries in terms of using those proceeds to pay down the loans, or comparatively, you might have a loan that's guaranteed by the state, and the state puts up resources, right? Land and commodity resources in order to guarantee repayment of the deal. Sinosure also enters these deals, which is a state-backed commercial insurance in China, in order to help secure the deals as well. But undoubtedly, right, some key channels and key ways of mitigating sovereign risk for China are these administrative channels, are these contracts that feature things like cross-default clauses, contracts that even have special accounts, right, through these commodity-backed loans that are directed specifically towards debt repayment. Here's an example of a cross-default clause. This is from the Argentina contract for the Santa Cruz hydroelectric dams. And as you can see, right here in 21.4, if you look at B, it says, if they're in the event of a default under the Belgrano facility agreement, there would be a cross default, a link, right, into also defaulting on these hydroelectric plants. Ironically, right, it was ultimately concern about the hydroelectric plant that caused China to threaten, right, this cross default clause in its negotiations with Argentina. But ironically, Chinese content was a lot higher with the Belgrano Railway, and the financing terms from China to Argentina were a lot better with the Santa Cruz hydroelectric dam. So China was afraid that the Belgrano Railway would never go forward, right? And that's why they put the cross default clause into the deal. So now let's look at the other part of the trade-off, right? To some extent, Chinese loans come into country, right? The lack of policy conditionality gives countries more fiscal space when there's a state-to-state loan. Now I said, okay, in exchange for that, there's commercial conditionality, right? The cost of having more degree of maneuverability with your fiscal policy, with your budgetary space, are commercial conditions, commercial conditionality. Now let's look what's happening here, right? Effectively, we label, if you go back to here, number one is highlighting kind of your Chinese foreign content and bilateral tied aid. Number two is highlighting tools to mitigate and manage sovereign risk. As you can see in this graph here, right, the gray represents state-to-state deals. And you could see sort of when China moves from sort of, the Chinese corporate financing deals to state-to-state financing deals, one thing we see with the gray, these state-to-state financing deals, is they tend to have a lot more of number two. That means the commercial conditionality that's oriented towards managing sovereign risk, cross-default clauses, commodity guarantees, all these things become much more likely with state-to-state deals than when we have Chinese corporate financing instead, right? Money flowing directly to the corporate financial sector. Under those conditions, we see tied aid, but not necessarily as frequently that high degree of sort of tools used to manage sovereign risk in the state-to-state relationship. You can see it here as well, right? As China's state-to-state financing accounts for a higher share of total Chinese financing, right? We see Chinese commercial conditions start to expand, right? So that's China's way with these commercial conditions of either hedging its risk or promoting its commercial sector enough, maximizing markets enough where the potential cost, right, or default risk may be worth it if they've expanded enough from a commercial and market presence. Okay, so now let's look at the cost and benefits in a little more detail before we close up here for our last 5 minutes or so. So what we've seen of the benefits of Chinese financing, well, it's longer term and it can align with the region's development horizon, right? The extent to which regions like Latin America want to have more fiscal space, they want to have more policy maneuverability in order to increase social spending, infrastructure, things along these lines. China's financing can be complementary, right? We've seen, right, during the age of austerity in the 90s into 2000s, many Latin American governments had to cut, right, their infrastructure budgets, where infrastructure represented 3%, right, of GDP in the 1980s, represents about 0.6% of GDP in the 2000s, right? So Latin America's infrastructure spending had a huge deficit. China comes along, willing to fill that deficit, and governments can get more policy flexibility from that, right? More policy space, fiscal space to spend. What are the costs? Commercial conditionality, right? The loans are tied to Chinese firms, products, and machinery. So what ends up happening is similar to trade, Latin America must negotiate its share of local content when it's negotiating a finance and commercial deal with China, right? China is going to try to maximize its interest of its firms, right, over time. And Argentina, comparatively, or other Latin American countries are going to have to maximize their share of local content. So from this perspective, it's very similar to a trade deal, right? So something like, the Argentine Railway, Belgrano Railway, effectively locomotives, China wants to import as it builds sort of that railway. No problem, because Argentina doesn't build locomotives, right? So China, that kind of Chinese content, no problem. However, there is industry in the railway ties, right? Argentina does build those railway ties. So that's an element of the negotiation where increasingly Argentina tried to assert itself and say, we want to produce those railway ties, not China. And that's a part of the negotiation. But because it's commercial conditionality and not policy conditionality, effectively, governments have to be ready to negotiate the same way they would on a trade deal, right? This is not development financing in the free sense, right? It's development financing in the commercial sense. Comparatively, we also have a middle income trap, right? There's concerns about a middle income trap. What happens as China comes in with these big state-to-state loans, right? They're oriented towards infrastructure, but also oftentimes towards energy and promoting, right, the use of Chinese capital inputs in those sectors. So then there's a question, if the long-standing policy question within Latin America has been industrial diversification, moving away from commodity dependency and building your industrial sector, to what extent, if China is coming in, trying to increase its presence in commodity and energy sectors, right? And simultaneously, you're importing a lot of industrial goods. What does that do to your ability to diversify into industry, for your ability, right, to upgrade? Now, China is well aware of this, and China has promised Latin America that it'll bring more industry and more complementarities, right? But there are real questions here in terms of when that industry has come. It has tended to be places like the automobile sector in Brazil. In fact, 1/10 of Chinese FDI has been destined for the Latin American manufacturing sector, but 2/3 of it has gone to Brazil. And in general, labor costs are a lot higher in Latin America than Africa or Southeast Asia. So would this kind of industrial upgrading actually work for Latin America? So there's a real key question in terms of middle income trap here. And then finally, there's a real key question in terms of indebtedness, right? And when I talk about indebtedness, I'm not talking about debt trap diplomacy, okay? Because that is a narrative that I do not think is empirically true. I think what happens is much more along the lines of, as we'll see in a moment, kind of a creditor trap rather than a debtor trap. China is a rising creditor internationally. They're trying to use subsidized cheap policy bank financing to expand their commercial and market presence, but sometimes they bet wrong. They bet wrong, there's a cost, and that cost is indebtedness, right? So I would rather call this, as we see rising indebtedness in places like Latin America and increased restructuring, I would actually call it mispriced risk from the Chinese perspective rather than an intentional debt trap. We can always get into more of that within the Q&A as well. Just want to kind of share a few more graphs before we kind of close out our time here with the presentation. First, you can see this looks like at the question of intensifying middle income trap. And you can see that Latin America's high-tech manufacturing imports from China, since China joined the WTO, have just grown over time. And even after the global financial crisis, when China's financing comes into China, right, they've continued to grow over time. So there's a real question here in terms of industrial competitiveness and middle income trap moving forward. There's also sort of this question of commodity dependence as a potential cost, right? Here you see right? Latin America's primary commodity exports to China expanding relative to Latin America's manufacturing good exports to China, right? So even though Latin American manufacturing good exports to China were far lower when China entered the WTO compared to their primary commodity exports, not surprisingly, those patterns have intensified since 2002 and since the global financial crisis, where Latin American manufacturing good exports are declining and their primary commodities are expanding, raising the question of commodity dependency moving forward. And finally, right, we can then look at the cost in terms of indebtedness. This is the last cost, and then we'll close it up. In terms of indebtedness, the lack of policy conditionality creates a moral hazard problem, right? The extent to which countries like Venezuela or Ecuador know they can spend money, expand that public balance sheet. China doesn't have policy conditionality, even if they would prefer, right, a government is a bit more austere. There's no policy conditionality. So there's an implicit ability, right, an implicit message sent that those governments can expand their state balance sheets under Chinese financing, right? We see that happening in Venezuela from the time it first received Chinese financing in the prelude to the global financial crisis, right through to the 2014 commodity downturn. Now what's happened, right? As those bets, right? China wanted to grow its commercial presence in a place like Venezuela, wanted to grow, right, its energy presence. And so it made this bet and it financed it with policy bank loans. What happened as those bets went awry, as Venezuela entered, as the Maduro government mismanaged the economy and they entered a humanitarian economic crisis, we now see it struggling to repay $17 to $20 billion, right, of Chinese debt. And the proceeds that China secured that debt with, what are those proceeds? Oil production, right? Proceeds from that oil production dropped to below 350,000 barrels per day in 2020, which is less than 15% of 2013 output. 15% of 2013 output. So if you're hedging your risk with these commodities, well, as oil production collapsed in Venezuela, right, then the ability for China to get its money back collapsed as well. So we see China entering a debt moratorium with Venezuela beginning in 2016 and going right through COVID to present day as a result of this. So a few graphs just to kind of see these relationships in a bit more detail. You can see here, this first graph, right, is looking at the composition of Venezuela's foreign debt. The red, right, someone commented that the book actually has a blue cover, which is rare because quite often, China books have a red cover. So yes, it has a blue cover, but I didn't necessarily carry that blue through the graph. The red here highlights China, but as you can see, and this is where I think the debt trap kind of idea goes awry as well, China is responsible for about 20% of Venezuela's foreign debt, right? You have a lot of that other commercial actors, market actors, Wall Street that's responsible for a lot higher share of Venezuela's foreign debt. But we could see this debt expanding through 200% by 2019, right? And that's obviously becoming a problem for China and put China now in this defensive lending position. Next, we see in the following graph, we see cash flows in exported barrels per day. These are the proceeds, right, that Venezuela earns in order to be able to repay its debt with China and others. As those proceeds have collapsed, right, through 2019, the yellow is what it owns Russia. The red is what it owns China. You could see the blue are the proceeds for everything else that company needs to do. So the extent to which it's repaying even China or Russia on these loans, it has less and less oil production in general that's collapsed. It's 15% of its 2030 levels. And in addition to that, right, there's very little money left over to put back in the company, which means it's even going to have lower and lower oil production as a result, showing you the way that China mispriced its risk by trying to securitize it with commodities. So finally, and we can talk about this, in the Q&A, what is China doing as a result? We're seeing them take more of a diversified strategy in terms of its lending. Rather than being sort of state to state first, it's still that state to state lending is responsible for the majority of Latin American debt today with China, but we're seeing it trying to diversify into equity channels rather than debt channels. We're seeing it try to use more multilateral investment partners, including the World Bank and the Inter-American Development Bank. And so the way it's behaving and the way it's approaching Latin America is changing. For example, as $40 billion in Latin American funds that it created in the wake of the 2014 commodity downturn in order to invest state-backed funds directly in equity in Latin America. Now, importantly, it's only deployed about 2 billion of that funding to date, about 5% of its committed capital. But importantly, this is kind of another instrument where they can diversify, just like China did domestically. They use a diversified strategy for development. They're using that diversified strategy internationally now. State to state may have been the first mover. They're trying to expand into market mechanisms more, trying to expand into multilateral mechanisms more. So in closing, I leave you with the old saying that we know from John Maynard Keynes, essentially, that yes, China's money has come into Latin America and in many ways expanded government's ability to spend money, but that has come at a cost, right? And potential costs in terms of development and dependency. So what does that mean for China as well as Latin America? Well, it means that Latin America's got to be very wary of these trade-offs and the potential commercial costs here. And China has to be wary about mispricing risk as a creditor. As the old saying holds, owe your banker 1,000 pounds and you are at his mercy. Owe him 1 million pounds and the position is reversed. And we're seeing now China moving into that debt restructuring phase, trying to recover funds in places across Latin America, ranging from Venezuela to Ecuador to Argentina. Thank you very much. And I look forward to your comments and questions.
All right, thank you, Stephen, for a really informative, exciting presentation here. I'll just say before I introduce the moderators, I'll just say I think one thing that really strikes me as exceptional about this book is the way it goes from really sort of the micro level, like individual Chinese loan projects in specific Latin American countries, to like really big picture questions about the role of China and world politics and state capacity and the impact of globalization on Latin America. So, sort of really remarkable there, and something I think grad students and other junior scholars out there should, seek to emulate, this ability to sort of navigate both the really micro level stuff and also address really big picture questions. So, congratulations on being able to do that so effectively. So let me introduce our first discussant today. It's Muyong Chen. She's an assistant professor at the School of International Studies at Peking University. She's an expert on the role of the state in development and also on Chinese development finance and its impact on the global order. Her work has appeared in journals such as New Political Economy, Studies in Comparative International Development, Development Policy Review, and others. She has a PhD from the University of Washington as well. And thank you, Muyong. We look forward to your discussion of Stephen's book, and you have 10 minutes.
Okay, thank you, David, for the very kind introduction. Yeah, I would also like to take this opportunity to thank Professor Deborah Baltigan for inviting me. I enjoyed reading the book very much. I have been using your articles in my courses here at Beida, and our students really enjoyed discussing the articles. So it was really something I look forward to reading the book. As Professor Kaplan has presented just now, the book actually includes two main parts. The first part was sort of characterizing or conceptualizing Chinese policy bank lending. And the second part, the book is actually evaluating its effect or impact on Latin American countries. And I really like that the way you characterize Chinese lending as patient capital and highlighted the three main elements: long-term maturity horizon, high risk tolerance, and the lack of policy conditionality. And the effect of these kind of Chinese policy bank loans on Latin American state is, just to quote what's in the book, that they allow developing economies to sidestep the fiscal austerity tendencies of Western markets and multilaterals. And I really like that the book is empirically so rich. There is a statistical chapter, and then there are also multiple chapters based on a lot of empirical evidence from the fields. Like I'm really surprised that you get to interview so many Chinese government officials and also policy bankers, which is something really challenging to do. Even like I'm a Chinese national, so and I really like the way you conceptualize the how the main findings and argument goes with the book. But I have to be picky because I was told to be the discussant. So I will perhaps bring up a few questions and also comments as well. So my first questions are actually about like the three elements that you highlighted about patient capital. So essentially, like, to what extent do you think these three elements are peculiar to China? For example, we understand that Chinese capital is different from Western short-term capital that seek commercial interests. However, in Western economies, there are also long-term credit agencies like Export-Import Bank or other like official insurance companies, and you also mentioned multilaterals, which are supposed to be providing capital with longer term horizon and having like higher risk tolerance than commercial capital. So these kind of longer term capital offered by long-term credit agencies are not like non-existent in Western economies. If we compare the Chinese policy bank lending, like the Exim Bank and CDB, to the similar kind of ECAs, for example, then do we find more similarities between the two? And the third element, for example, is a lack of policy conditionality. And in the presentation in the book, you highlighted the kind of commercial conditionality. For example, we actually have observed this similar kind of financial instrument being employed by Western financiers as well. For example, let's say you mentioned the collateralized lending, for example, which are backed up by future receivables or future delivery, like future fiscal revenue or future exports. But collateralized future receivables are also employed by, or at least they have been employed by public borrowers in developing countries, let's say in the 90s or maybe 80s and 2000s, in order to borrow from the international market, either in the form of bond issuance or in the form of bank lending. So in that case, are these characteristics peculiar to China, or is it just like the developing economies have been using these kind of tools to borrow from multiple creditors? It's just like at this particular 2 decades, or like at this moment, China happened to be the largest creditor. Okay, so that's the first settled question. And my second question is about the categorization of Chinese capital. I really like that you actually differentiate different kinds of Chinese capital. There are state-to-state debts versus more commercially oriented corporate lending or equity investments. And as mentioned in your book, we observe an increasing amount of, for example, equity investment in Latin America. However, the total amount of equity investment is still quite kind of small in comparison to state-to-state debt. So I wonder, to what extent do you think that that is generalizable? Like with this kind of finding, we can be applied to other regions. For example, Chinese policy banks are also present in markets that are relatively better. Let's say some Southeast Asian country like Vietnam or Indonesia, where we observe more commercially oriented projects. Well, of course, Africa perhaps will be the region where we observe more like state-to-state debt. So do you think that Latin America like is a particular case that we observe so sort of more state-to-state financing? And also in the book, you mentioned that you have this new data set, and you cited Kaplan 2021, and you compared the data set with existing data set, for example, data, and also the dialogue. I'm actually surprised to see that actually they kind of differ from one another quite much. We all know that there exists an actual data set owned by the bank. It's just not published. So I truly appreciate that you collect this data set, which is very insightful and helpful for researchers. To what extent do you think the new data set reflect the entire picture of the actual project portfolio that's out there. I am also confused with this kind of method of collecting data, because if we look at the reported projects, usually it's the government ones are more likely to be reported than the pure commercial ones. So somehow there is a selection bias out there. But that said, I don't have a better way to access better data because the official data is confidential. Okay, and the third comment and question is relating to the last few slides that you just mentioned. That is the impact of Chinese lending on industrial development. So you argue that since many of the loans are guaranteed by collaterals or commodities, maybe this will cause a moral hazard, or maybe the borrowing countries will be dependent on their resources instead of building their own industrial chain domestically. However, there are other school of explanation. For example, the School of New Structural Economics led by Justin Lin would argue that Chinese capital, since it focuses a lot on infrastructure development, it sort of laid the foundation for industrial development. So there is actually two kinds of impact on industrial development. So I was just curious, how would you react to that kind of explanation on the impact of Chinese loans on infrastructure, industrial development? Yeah, so that would be my 3 comments and also questions. Yeah, but after all, I really liked your book.
Thank you very much.
Yeah, thank you, Muyong, for a really thoughtful set of comments and questions for Stephen here. And next, I'd like to introduce our other discussant, Austin Strange, who is an assistant professor in international relations in the Department of Politics and Public Administration at the University of Hong Kong. And he's also at the moment a postdoctoral fellow at the Columbia, Harvard, China, and the World program. He earned his PhD from government in Harvard University, and he's an expert in Chinese foreign policy, international development, and international political economy, with particular interest and expertise in China's overseas development finance, as well as China's influence in developing countries. And so we look forward to your comments as well. The floor is yours, Austin.
Thanks very much. Professor Brodegum, thank you for the invitation, and thanks to your colleagues at SAIS CARI for the invitation to discuss this new book, and thanks for the introduction, Professor Steinberg. It's an honor to be with you all today and discuss Professor Stephen Kaplan's new book. Stephen, congratulations. I remember you and I saw each other in Shanghai just before the start of the pandemic, and if my memory serves me correctly, you were finishing this book. So congratulations. For everyone else, I think this is a very compelling and very thorough study. I strongly recommend it for anyone interested in China's role in international development, as well as Chinese foreign policy more generally. Like Muyong, I'm going to try to be critical, but I want to just start with a few things I really like about the book, because I think it does a few things very uniquely well. One of which is it has a very unique comparative lens that I think a lot of us would be unable to produce on our own. And so Stephen, in his book, he takes host country environments very seriously. He draws on his regional expertise in Latin America. And in addition to his regional expertise, one of the kind of most surprising, one of the most pleasant surprises for me when I was reading the book were these interesting parallels between the United States' historical approach to Latin America and Chinese patient capital today, which I did not fully appreciate before I read this book. The book also really, in my opinion, effectively engages with the crucial link between China's own economy and its role in international development. I think all of us always say and kind of intuitively think that this link is really important, but not all studies flesh it out as well as this one does. And I think in particular, looking at the role of China Development Bank and China Exim Bank as well, as this absolutely central connection to the two is really effective. I don't know if this was already mentioned by any of the earlier speakers, but the book has over 250 interviews, many of which are elite. It's a very impressive mixed method study. As Muyong mentioned, it also has a new data set, which I think is especially nice because it focuses on disbursements rather than commitments, which a lot of us have focused on in our own work. And then finally, I think the concept of patient capital is really fresh and useful for studying Chinese development finance in new ways, in particular decomposing this umbrella term of Chinese loans into meaningfully different categories, state to state and market oriented in particular, and also just getting more serious about what are the most important variables in host countries that condition the nature and impact of Chinese financing. So I have 3 or 4, depending on time, 3 or 4 kind of questions slash comments that I want to unpack a little bit. And since the book is already finished, these are meant to be more forward-looking than suggestions for the current work. The first one is about the actual projects themselves that are produced using patient capital. And so much of the analysis in the book, in my read, is focused more on the financing modalities than the physical projects. And I think that makes sense given Professor Kaplan's objectives in the book. But a very, I think, evasive but also important second order question is how productive and value adding are the actual individual projects that are being financed with different types of patient capital? Can we decompose, for example, the term infrastructure and understand which types of projects in particular are most helpful and most problematic? I think on the one hand, the book gives us reason for concern when we look at the cases of, say, Venezuela and Ecuador, and some of the evidence suggests that quality projects do not always emerge, giving this fungibility to governments that are potentially corrupt or captured or have lax regulatory environments is not always a good thing. And so an obvious concern is that, in particular, the state-to-state type of patient capital is going to countries, as I said, with more flexible policies. And I think it's easy for a lot of us to kind of make this jump from flexible investment policies to perhaps weaker institutions or weaker governance in general, which is a bit concerning. But I also think there are lingering questions about the impact of individual projects. And this is where I think there's a big challenge, because there are serious measurement challenges with understanding kind of the costs and benefits of infrastructure projects. And this isn't necessarily specific to China. But first of all, what is specific to China is that there's a limited time series here. So China is a relatively new provider of large scale patient capital, at least internationally. In addition, infrastructure projects are notorious for being massive and extremely complex. They produce a lot of positive and negative spillovers that are difficult to measure. So is simply looking at countries' debt levels an adequate enough way to really understand the impacts of patient capital? I think that's one question. I think future research could provide a fuller, the book is already extremely rich, but future research could provide a larger menu by each country case, for example, of the actual projects being financed by the different types of patient capital. For example, by sector, by subnational location, for example, are state-to-state finance projects more politically driven within countries? Which types of capital produce more kind of national level versus regional level projects, so on and so forth. I think there's a lot to unpack at the project level. Similarly, I think looking at the China side benefits that are part of the argument of patient capital in the book would be insightful as well. And so this is, I think, on page 80, but I think this point is made throughout the book. Patient capital is meant to be this catalytic force that promotes a web of Chinese investors and suppliers and firms. I'd like to see some more examples of how this works as we kind of get from T equals 1 to T equals 2 and so on, and really understand what this patient time horizon looks like at the micro level. It's also a bit unclear to me whether these follow-up benefits from this market maximization are meant to be exclusive to SOEs, or are they meant to be spread to Chinese commercial actors more generally? So that's the first kind of big point on, on the actual projects. Second point, and I saw this come up in the Q&A chat as well, so I think this is worth asking, is about the scope conditions. So this is a study on Chinese capital in Latin America. We know China provides patient capital now, thanks to this book. Where are we most likely to have patient borrowers who can actually pull off these large projects? And where can patient capital really be successful in the medium and long term? The book makes 2 important points that I think are worth raising here. First of all, patient capital was important for China's own development, and China has a unique set of economic and political conditions, as we all know, that made this development possible. Second, the success of patient capital also depends heavily outside of China on host country governments. And so to me, this raises a natural question about the scope conditions. Which countries actually have the capacity not only to attract the patient capital, but to pull off these large projects over time? The evidence from the book suggests that having large stocks of natural resources or having big markets is an important starting point, because that gets you to the table in terms of being able to provide commercial conditionality, such as commodity-backed loans or contracts for Chinese SOEs. I was also wondering if we should pay more attention to public opinion. So Chinese investment is now a flashpoint for popular criticism, whether or not that is merited in some cases. Might that be a force of disruption in certain types of host environments? I was also wondering whether the healthy skepticism in a lot of Latin American countries for impatient capital provided by the United States and some of the quote unquote traditional providers is unique to the region or not. And similarly, should we use this kind of leftist and rightist government framework to understand kind of advocates of patient capital outside of the region? One final kind of question for Stephen on scope conditions. Can China's patient capital help low-income countries and smaller countries? Or are these middle-income countries with relatively rich resource endowments the sweet spot for China's patient capital? Third question is about the policy autonomy that host countries are gaining as a result of taking on, in particular, state-to-state patient capital. So the book, I don't know how much this came up in the presentation just now, but the book makes an interesting, I think, contribution to the broader IPE literature. It challenges this notion of the classic trilemma in which countries, debtor countries, oftentimes have really limited policy autonomy because of the nature of this trilemma. But I would argue that the commercial conditionality that Stephen outlines in the book actually limits future policy space, albeit in different ways than the classic trilemma. And I think, to be fair, this point is actually made in the book, but I'd just like to bring it out here. I think it limits potentially both economic and political decision-making in the future. Certainly, if one is meeting these commercial conditions, such as commodity-backed loans, that by definition will constrain one's policy space in terms of being able to allocate those future resources. But I think the more interesting kind of policy constraint that actually isn't discussed quite as much in the book is on the political side, and the fact that China does have really tight relations with a lot of the leaders of these countries. And right now, China is the main game in town in terms of providing patient capital. Is there really not a threat of exit if a political red line is crossed? And so I do wonder about whether the kind of net autonomy is actually increasing, or really if there's just a different type of dependence that is being fostered here. And I think I'm just about out of time, but I want to ask one more kind of more forward-looking question, which comes out in chapter 8 of the book, which is why isn't there more cooperation between China and other advocates of patient investing? And so patient capital has been around for a long time. Philanthropy and philanthropy organizations and lots of other international development actors have been advocating for this for a while. The incentives appear to be aligned from a material standpoint. China provides a lot of patient capital right now. It also has this growing learning and recognition that there's a creditor trap and it needs to potentially multilateralize, as chapter 8 discusses. And the international development community has recognized for years now that there's a major infrastructure gap and that more forms of patient capital are needed. I think this is one of the reasons why concepts like blended finance have gotten really popular, at least rhetorically, in recent years. So my question for Stephen in closing is, what explains the lack of progress? Is it because China isn't transparent enough to be an effective partner based on some of these more traditional standards? Is it because of overarching competition between China and some of the traditional creditors in the West? Or should we be more optimistic? Has there been a lot more progress in recent years, and is cooperation actually headed in a good direction despite all of the kind of the broader difficult state of relations between these creditors? So again, congrats, Stephen, and thanks for the opportunity to discuss.
Thank you very much.
All right, thank you, Austin, for the thoughtful comments as well. So it's time to sort of open this up to the Q&A, and I see that we've gotten a bunch of questions already. So maybe I'll start off with one question that's come up a few times that Austin has also sort of mentioned, which is a question about sort of regional variation. You know, so Stephen's book obviously focuses on China's loans, the impact on Latin America. There's some questions about how might the effect on Latin America differ from other regions. And Imogen Liu asked about the Western Balkans. Stefan Berwick asked about Africa, Southeast Asia, and Europe. So maybe this would be a useful place to start. You know, what is sort of unique and distinct about Latin America or not, and how much do we think that the insights that you're observing in Latin America are likely to travel elsewhere. Please, Stephen.
Sure. So what I'll try to do is, engage in sort of this line of questioning, and then as I'm doing it, try to highlight some different themes that came out from both Austin and Muyong's commentary as well. I'll do it briefly so we have time for questions. But in general, I think a good place to start is kind of with Austin's last question about, why don't we see more cooperation in the patient capital realm? And also this question about scope conditions, because I think the answer there helps address the implications in terms of how is Latin America different or similar to other regions. So I think, first of all, I guess I would characterize China on some level, right? We know in the international relations literature, there's sort of a lot of debate about China's willingness to kind of ascend to sort of a strong position internationally, right? Certainly President Xi is a big advocate of that. But then in general, right, there's sort of a part of that literature pointing to, well, China's also trying to find its identity, right? And find its place in international affairs as well. And I think in some ways, that's the answer to the question of patient capital and the extent to which it wants to cooperate, because I think there's an element of China that has this multilateral angle that's been built out over the last few years in particular. But then there's also kind of a clear emphasis on bilateralism, right? And so I think that in some ways, China wants to diversify its kind of debt burden and issues internationally through multilateralism. But at the same time, it also wants to be able to dictate sort of the terms of the resolution and restructuring and so forth financially from a bilateral level, right? So what do I mean by that? To get back to kind of Muyong's question of, oh, well, is this different from Western financing, et cetera, or even Japan's financing and Japan's experience historically with commodity for loan deals? And the answer is yes, because China also falls out of the institutions, right, from Paris Club to OECD, that might also sort of have a strong influence on the way it does its lending, right? And so what do I mean by that? Take the CDB, for example, right? There's an emphasis on bilateralism with the CDB. The CDB is one of the key creditors within Latin America. Yet, right, the CDB doesn't fall under, right, DSSI or other multilateral initiatives in terms of debt restructuring. That allows, notwithstanding China's joining those multilateral initiatives, it allows China to also deal with these problems bilaterally rather than multilaterally. And why it's important in terms of patient capital and risk tolerance is that, well, the CDB receives an implicit subsidy, right? An implicit subsidy that even though it's a commercial bank, it's borrowing from Chinese commercial banks domestically at sort of the highest credit rating possible, right? So it's able to get very cheap financing domestically, which allows it to be very risk tolerant internationally, right? And enter into these spaces in emerging market countries that can try to grow its market and commercial share. And that's also a really key point in terms of scope conditions now. Because China, this isn't necessarily, right, when we look at CDB lending abroad, when we look at the vast majority of lending to Latin America, this is not pure development lending, right? This is commercial, right? Essentially what's happening in Latin America is, right, China's trying to expand its space, right, in places like the Argentine nuclear sector in order to compete with Russia internationally. So effectively, it's willing to provide very cheap financing in order to grow that space and create sort of future vendor relationships with Argentina in that nuclear sector to build China's presence internationally, right? So then the scope conditions, undoubtedly, Latin America, where China is located, is mainly, right, middle income, right, emerging market type of countries. And so, China's really approaching these countries commercially rather than necessarily geopolitically first. Why that's important, and even rather than sort of development first. Why that's important is when we look relative to other regions, right? And what China is doing in Latin America versus other regions. As you get closer to China, as you get closer to the roots of the Belt and Road Initiative, to sort of Western provinces, right, in China, et cetera, it becomes more and more geopolitical rather than commercial. There may be commercial projects, but there's also kind of a real geopolitical, geoeconomic imperative that may be outweighing that commercial imperative. So I think certainly in terms of scope conditions, then it falls under kind of these emerging market powers. That being said, it doesn't mean that China might not use similar tools in these poorer countries as well, particularly if they are concerned about a certain market in that country. The last part that I would say in terms of externalizing from that would be interesting and also relates to Muyong's question is sort of the state versus the corporate sector. So as we kind of look at maybe beyond emerging market countries into countries that might be poorer, there may also be a question in those countries in terms of maybe China directly invests in equity if they think there's a good equity project in that country, which would have a smaller price tag. It wouldn't have this big state-to-state nominal value to it, but they might be able to kind of incrementally grow a presence there, perhaps solely beyond development. So I think that's part of the key features of how to compare region to region and the book's implications more broadly from a region to region level. So hopefully that's helpful.
Great, thank you, Stephen. So I'll give you sort of two more questions. There was a few questions, actually probably more than two, but I'll sort of start with these two to not throw too much at you about the concept of commercial conditionality and how that works. So Kanye Liu asked about whether the Chinese content of commercial conditionality is unique to Chinese financing, or is this something that could be applied to other export credit agencies like the US Exim Bank and others? There was also another question there about the uniqueness of the cross default clause. How much is that sort of specific to Chinese financing? And there was also a question by Bryce Turner about the role of Chinese commercial conditionality in China's vaccine diplomacy and what China is getting with medical aid, and should we, can this concept apply there? So maybe we'll start with these sort of questions about, sort of the uniqueness of Chinese commercial conditionality and how much it maybe applies to sort of new forms of Chinese economic diplomacy.
Great. Yeah, and actually I think that's a good segue, right? Where I highlighted on net the main scope conditions for the book being sort of emerging market, middle income kind of countries. That being said, right, I think that question also picks up just where I left off in a really key feature that these are tools, right? And China's toolkit can be used in a variety of ways, and they can use this toolkit even in poorer countries as well. And I think vaccine diplomacy is a perfect example, right? Where effectively, just like you can make an argument, right, that there's a marketing distribution element to patient capital in those loans, right? Even though this is aid, you can make an argument that there's a branding element here, right? There's a branding element in terms of China wanting to expand its health presence in places like Latin America. That's been very low on the priority list in a place like Latin America historically. Through this branding, right? You have a Chinese company front and center internationally amid COVID. It is a terrific branding exercise. And I do think it's a way, particularly in lower income countries, to grow the Chinese presence, even through aid in the long term, commercially perhaps in areas like health as well. So undoubtedly, I think you can apply patient capital to poorer countries in that way as well. In terms of then looking at how different is this, right? Ultimately from what Western financing has done historically. And I think this is a great question. And I think to some extent, yes, there are similar features, right? If you look at the Center for Global Development's work and Anna Gelpern from Georgetown, right? She does a legal analysis of these documents. And undoubtedly, right, there are similarities in terms of what I have found within Latin America, what people like the Center for Global Development have found simultaneously. And yes, right, you could have cross default clauses elsewhere. You can have tied aid elsewhere. This isn't surprising. But to some extent, it's sort of the way these tools may be employed, right? And the language of the legal documents in terms of prioritizing China relative to other creditors, right? And that's what really starts to stand out here in terms of the contracts themselves, right? That on some level, the secured accounts, right? When I talked about commodity oil for loan deals, right? They're happening in special accounts that are linked to receiving the proceeds from those oil for loan deals. So according to the legal contracts, right, if people like Anna Gelpern, right, if their analysis is correct, essentially what they're highlighting is that China may be able to give preference to those special accounts, keep those accounts out of debt restructuring, out of Paris agreements, et cetera. Well, if that's the case, right, then that might give Chinese credit sort of special privilege relative to other creditors. So that's kind of one key, I think, feature to outline here in terms of the differences in what we see. I think also it's very key to highlight is sort of, I mentioned it before, but it's worth reiterating too, is the scale of this financing and the extent of subsidization, regardless of where that interest rate eventually falls, in that you have a commercial bank, a quasi-commercial bank in CDB, which is accounting for about 90% of the loans in Latin America, supposedly acting as a commercial bank. We already said CDB does not fall under the debt, initiatives multilaterally, right? The Paris agreements or DSSI or any of this, but also CDB gets this AAA rating, right? Is able to borrow really cheap from China's domestic banks and then marshal all this capital internationally. So the fact that China has the scale and subsidization to do this, and the financial regulations domestically that are willing to give, right, forbearance to the banks. They don't have to recognize, right, this on their balance sheets, right, the same way Western banks would. That's a huge advantage in terms of operating in this commercial space, allows essentially China to use cheap financing, cheap credit in order to expand their market presence. Think of my discussions with Argentine negotiators about the nuclear deal in Argentina. And I asked, well, why are you willing to do it? They're like, we would never do this deal if it wasn't for the concessional financing, for the cheap financing, right? But then from China's perspective, and this gets to Austin's line of questioning as well, it then helps them expand their market space, expand opportunities in the nuclear sector moving forward. Now, of course, from a development perspective, certain development projects are going to be better than others, right? And this is kind of the variation that I think Austin was rightly focused on, kind of moving forward in terms of what are the implications. Well, you see that variation in a place like Argentina, right, where arguably, right, China benefits in terms of its presence in the nuclear sector by investing in Argentine's nuclear sector. We then have Argentina can greatly benefit from a development perspective from the Belgrano Railway. Why? If you've ever been to Argentina, cargo, 95% of cargo travels on highways, right? 2-lane roads, right? Where you have to pass another car if you want to be able to keep your time. More than one time, I've grabbed my wife's hands like Thelma and Louise and closed my eyes and prayed as I passed the truck, right? Comparatively, 70% of Argentina can be covered in railway, right? And that can be used for transport instead. That would be a developmentally sustainable project compared to the nuclear project, which in some level is more about cheap financing to expand China's presence, and compared to prestige projects, right? Austin's written a bunch about prestige projects. You could call sort of the hydroelectric plants in the south of Argentina, even though sort of soccer stadiums in Costa Rica fit that description the best. You have cheap financing to your Kirchner government with their name put on hydroelectric dams in the south of Argentina in very questionable sustainable development terms, right? And so I think you get that variation in terms of the utility of the infrastructure project very much within Argentina. Just to highlight one last point of Muyong was highlighting, indeed, I absolutely agree with Muyong when she says, okay, isn't the Chinese model one where infrastructure comes first? And that's the multiplier. And then that builds trade and investment ties and even, right, complementarities in terms of technology. Eventually take cases like Kenya. I agree with that sort of characterization of China's development model. I certainly highlight that in the book. I think the question as it expands out in Latin America and elsewhere is once you build that infrastructure, how can you ensure the complementarities that follow from that infrastructure, right? Trade ties are a lot easier than necessarily deeper manufacturing and value-added chain ties, right? So I think that's really the challenge for both China and Latin America moving forward. But great questions. Thank you very much.
All right, so we have just 5 minutes left. So I think maybe what I will do here, Stephen, is there are two more questions that are somewhat related that I think will allow you to kind of build on this line of discussion here. So One is from Deborah Brockham. She asks some questions about, as the sort of line of discussion here, asking you to, what happens if we disaggregate Chinese lenders, Development Bank and Exim, for example? Do we see differences in patient capital? Exim Bank is always tied to Chinese goods and services. It seems CDB is not. Related to this, what's the risk or incidence of embezzlement when Chinese funds go directly to the borrowing government? And then when land is used as a part of credit enhancement, how does that use of fixed assets compare to the use of cynosure or security via commodity flows? So a range of sort of questions about how these, to some extent, conditionalities work and distinctions between different Chinese lenders. And then Zhijiang Wang has some, I think, related questions. The question is that Chinese banks, unlike Western banks, aim to maximize market and not individual firm profits. This strategy then goes on to influence a lot of the practices you describe. Where did this strategy come from? What kinds of past experience, ideology, or external factors shaped these strategies? And then maybe perhaps we can end on the second question from Zhijiang, which is this strategy sustainable in the long run? And given that it's not profit driven and there's a risk of this creditor trap. So maybe in the last 3 minutes left, we can try and tackle 10 excellent questions bundled in there.
Sure. So I'll try to move through them quickly, but happy to answer further questions over email or in individual conversations as well. Divergence, right, in terms of disaggregation, CDB versus Exim Bank within Latin America. 90% of loans in Latin America are coming from the CDB. So undoubtedly, sort of the patient capital and the way I'm describing the book is also probably most most descriptive of CDB. But it's not to say that we don't always also see elements in the Exim Bank strategy as well, right? For example, the strategy I mentioned earlier, yes, there's more of a trade focus, but their concessional aid or cheaper financing was used as part of that nuclear deal with Argentina, right? What that's really about expanding market space for China there as well, right? So I do still see, even if the amount extended is lower, even if sometimes it's trade first, you still see Exim Bank using some of the similar strategies CDB, just less frequently. In terms of land, right, and how is land incorporated into these deals? Jamaica is probably the best case, right, where land was actually used as collateral for the Jamaican cases or as an asset that's part of the negotiations, right? So if China is building infrastructure in Jamaica and highways, they're also getting, right, land concessions along the way as they build those highways as well, right? And so that's sort of how land enters either as collateral as part of the broader deal, or sometimes even in exchange for the terms of the deal, right? Like Jamaica was in a big hole. They had all kinds of infrastructure that was left undone. Many people were very unhappy in Jamaica with the extent of potholes and the poor infrastructure. And they had an infrastructure project half done, right? So they needed this money from China and to some extent Jamaica used land as a way to open up that financing. We also see there's some questions then about where does market maximization, patient capital, all these different things I find in my book being implemented internationally, where does it stem from? Where does it come from historically? Well, a lot of it comes from China's domestic model, their domestic market and what they did domestically. This was sort of Austin's point earlier. The use of vendor financing or the use of we know we want to expand our markets domestically in hydroelectric. We're not sure if we're going to be able to do it. Maybe the World Bank isn't even willing to lend, but if we can lend and we make our hydroelectric firms profitable, they can use that capital and then they can then lend that capital out and start to have a multiplier effect within the economy, right? And so it's not only about infrastructure being a multiplier effect, it's also about that financing for infrastructure having multiplier effects in terms of financing with successful projects, hence the focus on market maximization. So if one entity, had many Chinese officials tell me, hey, if one entity goes belly up, they'll get it back down the road. If one project goes belly up, not one entity. If one project goes belly up, they'll get it back later, right? It'll come back to them and they're willing to do it. And that's part of the long-term focus, right? If you can get enough financing oriented or into the sector and open up things, the hope is enough trade and investment will follow that eventually you're going to have enough multiplier effects where even the companies that lost out in the beginning eventually get profitability. Finally, the final thing to conclude on is this model sustainable? Whoa, or is it, right? Thank you for Austin for using creditor trap rather than debt trap there, right? Is this going to be a creditor trap for China, or is it sustainable? I think what it comes down to is the extent of savings domestically in the developing country borrower, right? Why do I say that? Well, China was able to be successful with this model, right? And Deborah Brodigan sort of, keenly brought up the idea that, well, it goes state to state. Aren't there opportunities for rent seeking, corruption, given the lack of transparency? Certainly, right? As China developed, it had such a high savings rate, it could absorb any of these kind of costs. It could absorb sort of economic rent seeking, misallocation of funds, all these kinds of problems that might come along the way. Ecuador, a lot lower savings rate. If you misinvest in Ecuador, there is less room to recover. And as a result, we see China having to chase its initial investments by restructuring with countries like Ecuador again, because you don't have the same savings rate that allow for the same room for error, right? So you build hydroelectric plants in Ecuador. That's great. Ecuador needed energy independence, but at the same time, right, did you need the extent of capacity that was built in Ecuador? Are these projects functioning the way they should, right? How sustainable are these in the long run? The extent to which there are problems with some of the hydroelectric plants already in terms of walls and cracks and fissures. Ecuador is not a country that can absorb a lot of problems along those lines, right? And so for me, it comes back to domestic savings rates, particularly with these big state-to-state deals. And in countries with bigger savings rates, maybe there's capacity to absorb some of these losses. Smaller countries, even middle income, emerging market countries may have less savings, less room for error, and there's a higher likelihood of having mispriced risk or debt ensue from these investments. So thank you very much.
All right, thank you, Stephen, for the thoughtful presentation and those responses. Thank you to all the attendees, and especially those asking questions, and apologies that we weren't able to get through all of them, and the discussants as well, and to SAIS CARI for hosting this great event. With that in mind, I think we'll close this out, and I'll just remind you that there are 3 sessions left on this year's conference. So tune in next week for the next session on borrower agency. And so we'll bring this to a close. And again, thank you all for coming today.
Thank you, everybody, for great questions and great feedback. I appreciate it.